The art of dollar cost averaging is typically applied to longer term and higher time frame investing perspectives. But in this video, we'll show you not only how to apply this to your long-term techniques, but also how you can use the same principles to improve your average price when short-term trading. First things first, with any viable trading strategy, controlling the downside risk is always going to be key. So when building a trade thesis, you've got to consider where are you wrong? And then you can start thinking about your entries and exits. Once an out or an appropriate stop placement has been determined, then you can look at building into a position with the appropriate amount of shares and the best possible price corresponding to your stop location. Now, whether you're building a position in front of a stop level or averaging up into a position as it works for you in the money, the goal is to always smooth out that volatility in between using multiple entries instead of a single one. So what is dollar cost averaging on a long-term perspective? It's just the principle that can help you smooth out your overall price by buying shares at incremental levels for the same amount at specific time periods. That way, you buy more shares when the stock is lower, you buy less shares when the stock is higher because the dollar amount you're spending is the same. So now we want to try to apply this to day trading or short-term investing. Sometimes you call it cycling shares as a day trader, but the principle is really the same thing. It's in front of a key stop level and you're building in each time it gets down to a price to get multiple entries, not knowing exactly where the stock is going to turn. You want to get into position with multiple entries so that you have something outside of just that one particular price in front of your stop. Now, as an added bonus, if you're a day trader with access to direct markets, you got the ability to use a rebate fee structure so that you can add liquidity, get paid a rebate to do as such, so that when you're waiting for these multiple bids, you're getting fills and paid to get said fills each time by passively waiting at multiple prices. I have an example looking for a short position on this particular stock. It happens to be CCL, where you've got a top from the previous day's trade of 818 as resistance, looking to build a short position as it moves back up toward that price. Now, without knowing how close it's going to go to that 818, you intend to get in starting at $8, adding at 804, adding more shares as it gets to about 810, so that you have a position on the way to that level. Now, obviously, this will mean that you have the max amount of shares if it gets to that 818 level, but you have to predetermine how many total shares you want to have if it were to break that level, so that you can get in proper increments. If you're looking to grab 1,000, you might go 200, 200, 400, or you should be thinking about adding into it in some kind of an incremental time base as well. That's one live example of how you can build in using average prices and averaging into position. So in a quick summary, dollar cost averaging, it's not just for your long-term investing. The same principles can be used in your day trading to smooth out volatility and build into a position, getting you the best possible price. As always, tune into our live show daily and check out our free watch list by scanning the QR code below. See you in the markets.